Welcome to When the Facts Change. For this, my second show after my 2025 UK Government Budget Special at the end of November. This is now going to be a weekly show released on a Friday morning via my When the Facts Change Substack. And thanks so much for your support. Now, the Federal Reserve cut interest rates this week by 25 basis points from 3.5 to 3.75%. The US Central Bank's decision was expected, but there's much speculation over what that cut means for policy moves by the Bank of England here in London and other central banks around the world. With Donald Trump now going into campaign mode ahead of the congressional midterms in November 2026, here he is fronting a huge rally this week in Pennsylvania. The US president's been exerting huge pressure on the Fed to lower borrowing costs to get the UK economy moving. Fed Chair Jerome Powell's found himself under attack from the White House. This is the third Fed rate cut since August and the sixth since the summer of 2024. But despite toppy US inflation, Trump wants more. I discuss all this and more with When the Facts Change regular Helen Thomas, CEO and founder of the consultancy Blonde Money. Back in the UK, consumer and business sentiment is on the floor in the aftermath of Rachel Reeves' second tax hiking budget in a row. The Chancellor's £30 billion of tax hikes in late November on top of £40 billion of tax increases in last autumn's budget are stalling the economy and hammering household finances. And since Reeves' latest budget, of course, the Office for Budget Responsibility and the Treasury and Number 11 have been at each other's throats as the UK's policy-making framework has gone into meltdown. I'm joined in the studio by Shadow Chancellor Mel Stride to discuss what all this means for financial markets, what the Tories would do differently, and why his party is now advocating stiff controls on government spending. And in the run-up to Christmas, UK households are cutting back on spending at the fastest rate in nearly 5 years, according to new figures from Barclays. As well as rising taxation, cash-strapped shoppers are coming under severe price pressures too, with headline UK inflation still up at 3.6%. I'm joined by retail and services industry guru Kate Nicholls, CEO of UK Hospitality. We assess the state of consumer spending during this festive period, and what's clear is that shoppers really are cutting back. It's great to be releasing this show here on When the Facts Change, and this will now be a weekly offering, as I say, released on Friday mornings for my paying subscribers. Thanks again for supporting me. So let's get started by welcoming Blonde Money's CEO Helen Thomas to When the Facts Change. Helen Thomas, great to have you with us here on When the Facts Change. For me, I think the big financial story of the week is this Fed rate cut down to 3.5 to 3.75. Of course, the Fed has a range of policy rates, if you like. It wasn't surprising, but it's still significant, isn't it?
Absolutely. Well, look, the Federal Reserve is the trigger of the whole world's price of money, if you like, given that they're setting the price on US interest rates. And particularly significant, it's the end of the year. It comes with a lot of extra information about their forecasts. And of course, we're at a very key point on who the chair is going to be. Might be this at the end of the year, you think nothing happens. Well, actually, markets have been, to borrow a phrase, laser focused on this one.
It's the third rate cut in a row from the Fed. But inflation is still pretty toppy in America. It's 3% and very much on an upward trajectory. We had dissent from 3 of the 12 Fed policymakers. That's historically quite a big dissent. Yeah. I think the biggest for 5 or 6 years. Some people were looking for a 50 basis point cut, a half a percentage point, and the other 2 dissenters they actually wanted rates to be unchanged. Yeah, there's a different system in America. There's a kind of dual mandate. They're focusing on output as well as inflation. Do you think the White House really put pressure on the Fed to keep cutting rates, given that there is a sense that the US economy is getting weaker. Donald Trump is going into his campaign for the midterms, which don't start till, isn't until November 2026, but the campaign starts now. What do you think is going on politically that helped drive this interest rate decision?
Well, you're absolutely right that the politics is driving it, and that is quite a shift for the market to digest after years of technocratic central bankers, focusing on basis points on inflation. Now the politics of this is absolutely paramount. I would say, by the way, in the past, politics and economics have combined. We had Carney and Osborne, were working together effectively on their plans post austerity. We had Kuroda in Japan, was one of the arrows of Abenomics. So look, central banks and politicians, have to interact. But what is important is, as you said there, the political cycle, because cost of living, affordability in America is really ramping up in the discourse. And Trump, as we know, has been a very successful operator. So it would help him a lot if you could get those interest rates down. Although it's a really interesting combination, because you could have, of course, cutting interest rates would tend to raise inflation, so then it seems strange and counterintuitive. But I would look at it through what they call a reflation lens. And I think Trump's thinking, look, if he can cut those interest rates, boost growth, get jobs created, then in a way, people can survive higher inflation if they've got jobs, if they're getting paid higher wages, if everything is growing. And that seems to be the strategy he's going for. It is quite risky because a lot of changes happening to the US economy right now as to whether it will work. But that is going to be the key question for the US for the year coming up, is does this reflationary boom happen?
I want to move on to the UK in a moment, Helen, but just while we're here, as you say, the Federal Reserve, the sort of lodestar of central banking around the world, America really does set the policy tone. We now have a US president. The US has always had this dual mandate because it's got a reserve currency. The currency is demanded for its own sake, for transactions, as a store of value around the world. So America's generally been able to get away with looser monetary policy, generally been able to get away with taking more liberties with inflation because the currency doesn't come under such pressure. But now we're in a situation where, as you say, the president of the US is openly politicking with the central bank, openly insulting Jerome Powell. That crazy situation we saw earlier this year when Trump literally just turned up at the Fed and started chiding Jerome Powell about a cost overrun on a building project before Powell even arrived. This is a man that Trump, of course, appointed in his first term. But now we've got open sort of prodding and poking and attempts to publicly influence an independent central banker in America, of all places. Helen Thomas, are we seeing the beginning of the end of independent central banking, in America, in the UK, across the Western world? Because this has been the paradigm for our entire adult lives, that you have an independent central bank because politicians can't be trusted. Politicians will just keep yanking interest rates down, and to hell with inflation. Is this a paradigm shift?
Yes, but it is being driven more by the economics, and I'll explain why. So we've had a very long period, sort of almost 20-year period, where it was okay to outsource a lot of decisions to the central bank because China was coming online, which created a disinflationary pressure to the rest of the world. Inflation was relatively stable for a long period, and therefore it was quite easy for central banks to tinker around this inflation rate. That's completely changed now, and debt has ballooned, post-COVID and a number of other interventions. So the fiscal side of things has come more to bear. But if anything, we're returning to normal, actually. This is the paradigm shift. The paradigm shift is back to sort of a 1960s, 70s world. There were times when apparently Lyndon B. Johnson literally physically assaulted the then chair of the Federal Reserve, and apparently, and his ranch in Texas, thrust him up against the wall and said, you know, that's for the boys in Vietnam. And it was, you know, these things happen. These things happened. Because they didn't want to raise rates, and, you know, they wanted to raise rates, and he didn't want them to raise rates. So in a way, you know, 'twas ever thus. But I do think it is a significant shift for markets because, you know, look, that was before I was born. You know, the way that the world's investors are looking at things is a different framework, as you said, paradigm shift, and therefore, you know, everyone has to take that. That's all. There's like a political risk premium now in the mix. But the idea that central banks were ever really independent is actually, as I say, a bit up for grabs. I mentioned those examples to you. In Japan, Abe came in, Abenomics, promising to try and reflate the Japanese economy. He chose a central bank governor, Kuroda, to do that. You know, Osborne chose Mark Carney. So, you know, this idea that it suddenly appeared with Trump is a bit not quite the reality. But certainly it's I think the difference when I talk about those examples is actually they were all on the same page and voters were on the same page. Now, that was in a deflationary world where you loosen fiscal if you can, and you loosen monetary, definitely, or you tighten fiscal to sort out the debt, and then you loosen monetary. Now, much, much harder. And to conclude, I know I've gone on, Liam, but the reason it's more and more important is voters. Voters don't get to kick out the head of a central bank, and yet central bank decisions affect their everyday lives. Mortgages, savings.
Indeed. Always pleased when you go on, Helen. Two observations from me. We usually associate this kind of, you know, duffing up of central bankers by political leaders, you know, with sort of tin pot democracies, you know, it's sort of thing that you think happening in Latin America or Africa with respect. You know, President Erdogan in Turkey over recent years has famously publicly duffed up their central bank in order to get them to cut interest rates, even though inflation is going up. And another observation from me is, yes, LBJ did that, and yes, he eventually got his way, and then you had the big US inflation of the 70s that followed it. Okay, partly because of the oil price shocks as well of the early 70s, and then we needed, you know, that legendary 6'7" central banker Paul Volcker to be, you know, like the kind of Davros of anti-inflation policy, really squeezing in order to push inflation out of the US system from the 70s and into the 80s. Fascinating stuff, Helen Thomas. Let's just come briefly to the UK, because I know earlier this week you were at the Treasury Select Committee. You're a financial markets person to your fingertips, but you also follow politics very, very closely. You watched Rachel Reeves. How do you think she did? Where are we in terms of this Chancellor's ability now to command confidence across the world? Because that really is important for the cost of the UK's debt. We've got a £100 billion plus annual debt service bill with big knock-on effects for fiscal policy, welfare spending, and all the rest of it.
I think she was clearly under a lot of pressure and has been very rattled. And actually, she faced some difficult questions for the Treasury Select Committee. And it's a really important committee, by the way. People aren't aware, that has done over the years a great job of holding institutions to account and politicians. And actually, she got some tough questions from her own MPs, because it's composed of MPs from all the major parties. I was struck by, for example, one of the Labour MPs asked her, it was John Grady, I think, you know, can the market have confidence in your plan because so many of the tax rises are backloaded? Wouldn't it have been better to try and get some done now?
That's a point we made on the last edition of When the Facts Change, right? Straight after the budget.
Exactly. Now, her response was, I felt, quite timid and quite short, and she simply said, look, the mansion tax and the gambling tax and all these other taxes take a lot of time to implement, so we need a bit of a run-up to get there. I felt that was frankly unconvincing. I felt that her questioner wasn't all that convinced by it. The whole hearing was overshadowed by questions about leaks. There were moments it got very heated. Now, that isn't just a party political point. Go back to what we've just been talking about in institutional credibility. You know, we all, and particularly markets, have to have confidence in the process. And I don't think anyone could say of any party, of any description, that this budget process was in anything other than chaotic. And that in itself does create a question mark over the plans. I mean, that select committee hearing there was a section of it about the measures in the budget, but the first half was all about the process and the leaks and the market getting very volatile over these leaks. And actually, Rachel Reeves got very angry when she said that there was a 13th of November briefing to the Financial Times that had said, you know, they weren't going to do the income tax raise. Liam, you know, you've talked a lot about this. I mean, everyone was following this, weren't they? You know, they looked like they were going to do something, and they didn't. And Rachel Reeves said, no, that was partial and inaccurate. She was quite specific about that.
Blame the journalists, eh? Blame the journalists who your advisors have just dictated to, you know?
Well, she got pushback from the chair, Meg Hillier, again, a Labour MP, a very renowned, very solid, great at holding politicians to account.
She should be Chancellor. She should be Labour Chancellor, really.
She did a great job on this, because she said, look, she said about the journalist on the FT, he's a very renowned journalist. Are you saying, you know, he's making it up, basically? And obviously she couldn't say that.
Outrageous.
Look, I think this isn't going to go away, because we talk about credibility of institutions. If the market cannot trust what it's told, either from the OBR, the Treasury, the Bank of England, you know, all of them, they have to have we have to have faith in what they're communicating. We cannot underestimate communications in this day and age more than ever. So actually my takeaway from that Treasury Select Committee was, I think there are now question marks. There's got to be question marks over how the communication operates. And if we don't get to grips with that quickly, that will be a bit of a risk premium for the UK going forward.
I think you're absolutely right to focus on the fact that it's all about process at the moment. You know, journalists like us, nerdy journalists, we do over obsess on process, but process is really important when it comes to fiscal policy, management of a major economy like the UK, and so on. I think it goes further, Helen. I think we're now in a situation where it's not just about the communications, it's not just about, you know, interactions in the dark between journalists and special advisors. I think we're going to, or at least we should, at some stage have a sea change in the way our fiscal policy is managed. I think there's going to be major reforms in terms of the fiscal rules. I personally think having a fiscal rule that's all about highly politicised forecasts in 5 years' time. I mean, the idea that you can even get remotely close to what the deficit number will be in 5 years' time is insane. It's
not even doing 5 days' time.
Completely mad. But here's the thing. As a final thought for you, from you on this. Here's the thing. At the very moment that the process is most starkly revealed as being, you know, completely broken, that's when there's the maximum danger in changing the process, because if you change the process, it looks like you're moving the goalposts precisely when you're coming up against hard decisions. So now is not the time to change the fiscal rules, because we need to get through this period of danger where global markets are assessing the UK very, very closely and thinking, you know, are we going to dump this currency? Are we going to make life really hard for the UK? Are we going to, you know, massively ramp up government borrowing costs? And, you know, if the market decides to do that, you don't need me to tell you, then there is nothing that any elected politician in the world can do about that in the short term. The only way you can counter that is, you know, meaningful, credible decisions that demonstrate that you are going to focus on, you know, fiscal prudence and getting the national accounts back on some kind of even keel. You are prepared to take political pain in order to do that. You are prepared to make bold decisions, spending controls, maybe tax cuts to get the economy moving, but they're going to take time to come through. So I don't think we're going to see any reforms anytime soon, and I wouldn't advocate reforms to the process and the OBR and the Bank of England's independence and all that anytime soon. But crikey, as and when we get through this very febrile period, we seriously need to, I think, completely change the way we manage our fiscal policy, because ever since the OBR was introduced in 2010, you mentioned George Osborne, far from there being fiscal stability, there's been, various spasms of fiscal chaos, not least the one we've been living through over the last few months.
Yes, and I actually think, in a way, the reforms you're talking about, it's already beginning, and I know you want to do it from a position of strength, absolutely, but that the race has begun, because the OBR cannot. It's got to. It's already rethinking how it releases its information, how it interacts. We're going to get loads of inquiries. Those are all massive opportunities. The irony, actually, is with a government with such a large majority, you would think they could make that case. It's a very technocratic case. Maybe people think it doesn't matter, but it actually drives at the very heart of the fiscal programme, as you've suggested, Liam, that you've got to have a credible process and framework, whatever it may be. But it's got to be radically different from the one that we're in, because frankly, this one isn't really working. I don't think it's working for any part of the system, actually. The OBR have clearly felt under a lot of pressure and had to push back on that. The chair's gone. I think either this will be forced upon everyone because of a crisis, which looks to be, frankly, more the way we're headed over the years to come, or a government could take the bull by the horns. We all love inquiries and commissions, but you know what? They have got a big majority. Everyone seems to be saying, of every political stripe, let's sort this out. Maybe it is the time to do it. If you could communicate something at the end of the process that people had faith in. And that is where we come back to the sort of elephant in the room to our entire discussion, which is the weakness of this Prime Minister and Chancellor, their low net approval ratings, the problems within their own party, and of course the polls, which are continuing to be very soggy for them. And that, that's the real problem, really.
Helen Thomas, Miss Blonde Money herself, thanks a lot for appearing on When the Facts Change.
Thanks, Liam.
So that was Helen Thomas, CEO and co-founder of the consultancy Blonde Money, which specialises in the interface between politics and finance. She's been a former Treasury advisor and a former currency dealer, and she's a CFA charter holder. So proper financial literacy, Helen's always worth listening to. And now on to our main guest here in the When the Facts Change studio, Kate Nicholls, your chair of UK hospitality. For quite a few years now, with respect, you've been analysing, commenting on the UK economy, particularly retail, hospitality, consumer spending, and all the rest of it. We are in the festive period where, Oxford Street is just round the corner from where we are here in the studio. Is this a Merry Christmas? Are the sleigh bells ringing on those tills?
I think you've started to get a few signs of jingle bells, but they're very late and they are coming slowly. So you are seeing people back out. Footfall has started to pick up, but that late budget, the last payday before Christmas with a huge amount of uncertainty, meant that instead of a 2-month run up to Christmas, we've probably got 4 weeks.
A lot of people will grasp the notion that the UK high street is struggling. Even here in central London, there's boarded up shops, let alone out there in the regions and particularly in towns across Britain where so many people live. Retail is struggling with high business rates, high taxation, high levels of labour costs, given minimum wage increases. We'll come on to all that. But to what extent do you think that the budget made things worse? To what extent do you think, Kate, that the reason why this is such a slow Christmas, those Barclay numbers are pretty horrendous, is due to policy rather than the global economy?
I think it's undoubtedly down to policy, and it's 2 successive years. It starts well before Christmas. When you're looking at the high street, you're looking at consumer confidence. That's really what you're needed. Consumer confidence drives business confidence, drives investor confidence. And if you have consumers who don't feel confident to come out and spend, and let's not forget, last year there was a lot of optimism when you had a change of government and you had the election out of the way. You then had a summer of, there's a £22 billion black hole and we're going to have to tax you and we don't know what's happening. And we had exactly the same thing this year. That puts consumers off spending. So 2 dire bits of economic forecast information, if I was the Chancellor in the Treasury, sitting looking at it. You have got that Barclay card data that's out that shows that consumers are not spending. In the busiest quarter, you're not getting consumers spending. And also, you've got high levels of consumer savings. So the household savings ratio is higher now than it was in COVID.
Again, because people are frightened.
People are frightened.
Unemployment's rising.
They don't feel confident to spend.
Yeah.
They don't feel they've got permission to spend. You have the government saying there are lots of things that things could only get worse. And you have me popping up regularly and people like me saying we've got job losses, we've got business failures. So people don't feel confident. What we need the government to do is to start talking up a bit of confidence. That's before you overlay the policies. You then look at those policies and they are disproportionately hitting the high street and they are disproportionately hitting businesses in hospitality and retail. Property intensive, labour intensive businesses. We've got a 2-tier economy going on here and somebody really needs to wake up to that. You've got the industrial strategy, which picks winners, picks 8 exporters, and everybody else is left behind and they don't get the funding, they don't get the policy support. Worse than that, when you do introduce policies like national minimum wage, living wage, national insurance and jobs taxes, or business rates, you're disproportionately hitting those businesses that are already excluded. So you've got a have and have-nots going on here. And you're right, you look across the high streets in the country, footfall hasn't got back to pre-COVID levels.
Blimey.
COVID is 6 years in the rearview mirror, and those businesses still haven't got the footfall back. It's about 85%. Of pre-COVID levels. And they haven't recovered from the debt and they haven't recovered from the profit hit that they got. So you've got businesses that are weak, that are not able to grow and invest and are not able to expand. And that's why we're seeing shops closed and voids in the high street, because in previous crises, financial crash, you had hospitality that opened up, invested in high streets. It can't do that this time round. So the government is seeing pain today, but also pain tomorrow because you're not getting that investment going through. And if you're a customer, psychologically, you walk around your town centre, if 1 in 5 shops and restaurants and pubs are closed, you don't feel inclined to go out and spend, do you? And you might not go back to that high street again.
Just to explain to when the facts change, viewers and listeners, a lot of them will know this. They're a pretty knowledgeable bunch, but a lot of them don't. Just to explain what we mean by business rates and how business rates at the moment impact people on the high street, whether they own the shop that they're using or if they rent the shop that they're using. What's been happening to business rates and how does that disproportionately impact physical shopkeepers, as it were, rather than online retailers?
Well, the first thing is that the last time they did a fundamental overhaul of business rates was 1988. A lot of your listeners and viewers won't have been alive then. If they were shopping in a different way and we weren't carrying...
I was on my gap year.
You were on your gap year. I was roller skating with her Walkman on, but none of us...
And your leg warmers.
None of us had a computer in our pocket.
That's right, yeah.
And that's the big difference now. So it's set in old days where you valued the property. So a business rate is made up of 2 components. One is like council tax. How much is the property worth? How much could you sell it for?
Whether
how much
you rent
could you rent
or
it
own,
or not?
you pay the business rates.
And it's based on how much could you rent that property out for. So it works on the basis, very old-fashioned, that right in the centre of a town is going to be the most valuable property. Well, actually, it's probably not. The business that's doing the most money is in a shed just outside the M1 somewhere.
Aircraft hangar, massive car park.
Yeah. And those high street shops still paying those very high taxes. So you get a value and then you get a tax rate. based on the size of the property. Small business, small premises pays less, big premises pays more. And again, doesn't reflect the fact that you or I could be running a multi-million pound business from a tiny one-room premises, and a pub, bar, restaurant is in the middle of the high street where people are in a big, expensive population. So that's why hospitality generates 5% of GDP, pays 15% of business rates. Retail, pretty similar.
Because they're in prime locations.
They're in prime locations.
Because that's where the people are, right?
That's where the people are. Yeah. That's where everybody visits. Yeah. So they're paying a lot. And what the government has done this time round, valuations, they're revalued every 3 years. And property has gone up. So the last time they were valued was in the middle of COVID. The valuation has gone up. The government has looked at resettling and promised that they were going to reform it in favour of the high street, incentivise investment in the high street, and penalise the Amazon warehouses to make sure they pay their fair share. Penalise the wrong word. Make them pay their fair share. And they haven't delivered on that. And that's why you're still seeing pain on the high street.
It strikes me as incredible. If you're running a business, a retail business, a hospitality business, this business rates, it's so pernicious. It's a tax bill that you have to pay before you've made, let alone a single pound of profit, before you've even taken a single pound of revenue.
Well, you have to be able to know you're going to cover it before you can open your doors.
It's a massive barrier to starting a business.
It's huge. And there is a difference between hospitality and retail. So hospitality business rates are rated on the turnover of the business. A hypothetical. That's why we are so disproportionately impacted.
I see.
Turnover doesn't equate to profit, doesn't equate to ability
if you're a retailer, it's just on the value of the property.
If you're a retailer, it's on the value of the property. So the retailers weren't closed during COVID, most of them, so they traded through. And also, they get their online business, a large proportion of them get an online business that isn't based and isn't valued in their business rates. Our online businesses, whether that's takeaway, Deliveroo, Booking.com, all of those sales contribute to our business rates. So we're disproportionately hit in hospitality. And increasingly, as you've gone through cyclical changes, post the financial crash, retail's gone through structural change. Our high streets need experience and hospitality and places to eat and drink. That gets people coming out to the high street, spending money, and it increases dwell time in the retail and spend in the retail. So retailers are telling us we need good, dynamic, vibrant hospitality businesses, and they are struggling.
What's the answer here, Kate? Can our high streets survive the onslaught of online retail? Obviously, online retail already very high, already prominent, then rocketed during COVID. The high streets never recovered since then, as you say. What's the answer? I mean, have governments across the Western world got the guts to tax the big tech giants, the likes of Amazon and so on? I mean, there's such powerful interest groups now, aren't they?
They are, and then also you've got President Trump, who is talking about tariffs if you do online sales taxes. But we have to fundamentally rejig how we're looking at it. We have a tax system that's set for the 19th century, and we're in a 21st century online world. So you may need to look at different ways of taxing, and you may need to look at different ways of valuing businesses that employ people, that do create place, that do create jobs. You need to work out what is it you're wanting as a government. Government is all about tough choices, but knowing what you want and delivering it in policy terms. Business rates has a role to play because it's a tax on a premises, so you can't evade or avoid it. But just tax it differently. It's not outside the wit of man to be able to work out how big a warehouse is, what the value is that's going through that business, and taxing them accordingly.
Now, a lot of When the Facts Change viewers in the UK in particular will have noticed that, their local pub, it might not be open these days on a Monday, maybe even on a Tuesday as well. Same with a lot of restaurants. What's going on there? Is that largely energy bills? Is it wage bills? What are you hearing from the people that you talk to all the time?
It's a perfect storm of all of those. So you've got a toxic cocktail of costs that are hitting that sector. And as I say, these were businesses that were closed for the best part of 2 years during COVID. They've taken on debt in order to remain viable, but it's taken them a long time to repair those shattered balance sheets. You don't just bounce back overnight from a shock like that. And they haven't had the support to be able to adjust. You've gone straight into an energy crisis, an inflation crisis, a cost of living crisis, and put simply, the money coming through the front door isn't sufficient to cover the costs going through the business to deliver profit going out the bottom door. And then in the last two budgets, £3.4 billion of extra tax put onto the hospitality sector deliberately, of which pubs are a key part, but tax on jobs, tax on property, and that's a disproportionate burden. And for part-time entry-level jobs, that's where the burden of the employment tax came onto it.
Yeah.
At the same time, the government has looked at those 8 shiny bits of the economy that it wants to support. It's cut energy bills for those businesses. And at the same
Just outline
time,
some of those. Which ones do you mean, Kate?
life sciences, AI,
Okay.
technology, financial services, the city down the road.
I mean, they're generally going gangbusters anyway, aren't they?
Yeah, advanced manufacturing. So it's all those bright, shiny tech. 80% of employment in our economy is outside of those sectors.
Wow.
So they've got energy cuts for their bills funded by a supplement placed on hospitality energy bills. So, and I was yesterday at a meeting with the farmers. So the government is giving tax cuts to data centres for their energy use and charging farmers and pubs more for their energy to subsidise that. Now, that's a choice, but the government needs to be open about the choice it's making. Equally, the government is not wanting to put taxes on certain bits, income tax, more jobs taxes, but it is choosing to put it on our taxes on lower paid entry-level jobs. The government needs to be honest about the choices it's making and which bits of the economy are winning and losing. It's fine to pick winners in an industrial strategy, but you can't leave everybody else behind. Otherwise, the high streets, the places we live and work and want to go out and shop in, won't be there in the same way to be vibrant and dynamic.
Let's just focus a little bit more on energy, Kate, because it is a subject that fascinates me, and we have got pretty much the most expensive energy costs.
No, pretty much. We have commercial energy costs, the highest in the G20.
Of the leading 20 economies of the world, as it were. How much of an issue is this for your members, both in retail and hospitality? Obviously, it's an issue if you're making steel or you're an engineering company. But for the companies you represent, how big is this?
It's very big and it's growing. If you're in hospitality, if you're in retail, you have to put the lights on. You have to have a warm ambient temperature. If you're in hospitality and you're cooking, you have to fire up the air conditioning, the extractors, the grills. If you're in retail, you have to have fridges.
Yeah.
We are energy users. We need to. You can't run the business without it. So the government looks at energy intensive rather than who is reliant upon energy in that way. And after the Ukraine war, energy costs in our sector as a proportion of turnover, they used to be about the 6th most important. They went up to be the 2nd. They even
After labour
overtook
costs.
business rates after labour costs.
Wow.
Labour is far and away
Of course,
the biggest
yeah.
in
Service sector,
hospitality.
of course. Yeah.
So, 55% of our operating costs are labour. It's much less in retail because we've done a lot of tech and investment.
Yeah.
But yeah, so after labour, utilities used to be low down. It's now increasingly high. And bills have come off the height. So at the peak of it, in the energy crisis back in 2023, we were seeing 400% increases in energy bills.
Wow.
But we're not seeing that level of increase, but we're not seeing them come down either. And critically in commercial, we're seeing the connection charges, the service charges, rather than the energy usage.
That's if you
where
can
you're
get a
seeing
connection to the national grid.
Yeah.
It's so difficult. It's
Well,
crazy.
we had a small pub wanting to expand, wanting to put in a kitchen and an extractor fan and a couple of bedrooms.
Should be basic.
Should be basic. They're in the rural economy and they were told they'd have to pay for the grid upgrade connectivity because the houses down the street wouldn't be able to put their ovens on at the same time. That's nuts.
Absolutely
That's nuts.
Absolutely
And
nuts.
to say
so
to
all
us-
that economic activity that would have generated tax, employment, turnover, more tax, doesn't now exist because of some swinging bill the state wanted to give somebody that's trying to expand their business.
Absolutely. And if
Completely
we've got
mad.
such a problem with grid capacity, we need to invest in that.
And finally, for now, Kate, what would you do if you were, in the cabinet? What for your sector, for hospitality in particular, consumer spending in general? in a nutshell, what is the Kate Nicholls manifesto?
In a nutshell, that's going to be challenging to do quickly. You cannot tackle the cost of living till you tackle the cost of doing business. I would reverse that cut in the NIC threshold so that we can get people back into work.
Gone all the way down to £5,000, hasn't it?
Gone down to £5,000. That means that you used to be able to work a 20-hour shift without an employer having to pay tax. It's now 8 hours. No wonder those jobs have gone.
No wonder the kids, students, people getting the first rung on the employment ladder.
Exactly.
So difficult now.
So I would reverse that straight away to get people off welfare into work, and we can invest in them, give them the dignity of work. And then the second one, the quickest thing you can do if you want to stimulate demand and those consumers need a signal that they can go out and spend because they're sitting on lots of cash, they're not spending on credit cards, cut VAT.
Kate, for now, thanks for the chat. So that was Kate Nicholls, CEO of UK Hospitality, and she's going to be staying with me here in the studio. Now, Rachel Reeves has been under huge pressure, of course, since her budget statement on Wednesday, the 26th of November. The Chancellor this week appeared at the Commons Treasury Select Committee, where, after revelations from the OBR, she overstated the extent of the UK's upcoming fiscal deficit, allegedly to justify tax rises to fund the higher welfare spending demanded by Labour backbenchers. The Chancellor was accused of market manipulation and misleading the House of Commons. So joining me now to discuss the most chaotic budget run-up, statement and aftermath that I can remember, and I've been covering UK budgets for the best part of 30 years, I'm joined by Shadow Chancellor Mel Stride. Mel Stride, great to have you here on When the Facts Change. Let's just talk first about employment, this row, as it were, between Rachel Reeves claiming the jobs market's getting better and your colleague, former Cabinet Minister Esther McFay. They had a bit of a clash in the Commons. It strikes me that it's pretty clear what's happening. Unemployment under this government's gone up from 4.2% to 5%.
Yeah, bang on. So we've seen unemployment going up. In fact, it's at a 5-year high. It's at the highest level since the pandemic. And what we also know, Liam, is that if you look at the OBR's forecast for the recent budget, that shows that unemployment is going to be at a higher level or higher forecasted level for every year of that forecast compared to the forecast back in the spring. So it's been getting worse. And, you know, if you ask the question, why is it getting so bad? Well, part of the reason is the national insurance tax that's been piled on businesses. It's a tax on jobs. And it's not surprising that if you do that, you see higher unemployment.
And also, I'd say these minimum wage increases. We've had 2 inflation-busting increases in the minimum wage. One came in under Labour in April. The other one is penciled in for next April. And particularly high minimum wage increases for younger people, Mel, leading to higher youth unemployment. Why? But Reeves says that overall employment has gone up, and that is what the figures show. But payrolled numbers of employment, people on payroll jobs working for firms, have been coming down sharply. It strikes me that a lot of people, in order to try and cope in this labour market, are going self-employed.
Well, some may well be doing that because of the different tax treatment. So sort of going self-employed or incorporating themselves in order to get a more advantageous tax treatment, which is what happens when you start to put up taxes on employment on payrolls. But on the younger people point, focusing on the NIC's increase at the moment, of course, it was an increase in the rate, but also an almost halving of the threshold at which that tax cuts in. And what that does, of course, is means that it disproportionately impacts those people on lower or relatively lower wages, and that includes lots of young people, people starting on their first job. And if you look at an area like hospitality, around 90,000 jobs have been destroyed in that sector alone. And that's, you know, no surprise. If you tax something, you tend to get less of it. And that's what partly the employment story is about. There's one other thing I would add, though, Liam, which is the regulation coming down the track around the Employment Rights Act. That is just going to add to friction in the labour market. It's going to make it riskier to take people on, particularly young people who don't have an employment track record. So, it's not surprising that, the government talks about the almost 1 million not in employment training or education, but,
So-called NEETs.
NEETs, they are not doing the right things to encourage those people to be getting into work.
Just before we broaden it out, Mel, if I may, on the Employment Rights Act, there has been parliamentary ping pong. I know your party has been scrutinising that employment rights legislation, what a lot of people have called a sort of 1970s Tribute Act, a piece of legislation written by the trade unions, basically. Your party, in particular, Joanne Cash and other Tory lawyers that you have in the Lords, have been pushing back. You have had some impact there, haven't you? Because originally, Angela Rayner and the left of the Labour Party wanted to have access to unfair dismissal rights and other entitlements for employees from day one of employment rather than after a 2-year probation period,
Yeah.
which is the norm for many years. There is now going to be a probation period. I believe it's going to be 6 months, right?
Correct. Yeah. That was the deal. So I take my hat off to the job that our peers have done in the House of Lords in really contesting this piece of legislation. And you're right, there's been an agreement that actually it will now mean that you have to wait 6 months before you can take your employer to an unfair employment tribunal. But that's still a big change from the 2 years there before. So it's still going to weigh in particularly on younger people, those that haven't got the track record. And when the employer might think, I've got to be really sure of taking this person on because if it all goes horribly wrong, I might be facing a tribunal within just 6 months. And so, that's a big thing. Now, the other thing, though, that we've heard recently is that the potential fines or the damages that can be achieved through going for a tribunal, which are currently capped, may actually now be uncapped. And what that's going to do is obviously increase further the kind of risk that employers will be looking at when they take people on. And let's not forget what happens with these employment tribunals. So often somebody will make a claim against an employer, it gets lodged, it's probably not going to be heard for 18 months to 2 years. And during that time, the lawyers who are advising the employer are so often saying, look, you're just much better off just to settle this. It's going to cost you a fortune to fight it anyway. And that is a dynamic within the way in which this works. And it's just not right, particularly for smaller businesses that find it really hard to cope with.
It's such a shame because there are so many great employees out there. There are so many great employers out there. You've run a small business successfully on both sides of the Atlantic. I know your colleague, Shadow Business Secretary Andrew Griffith, has a lot of hands-on experience running a bigger company, as it were. And it's a shame because employers and employees generally want to do the right thing for the business and for each other. It's a symbiotic thing, but there are vexatious claims. There are some employees out there who will, try and take a business to the cleaners, particularly a smaller business, as you say, because they won't have the resources, the bandwidth, the sort of legal department to fight these vexatious claims.
Yeah, that's absolutely right. There's often those very same smaller businesses, of course, who are struggling particularly with things like rises in business rates. You think about shops and high streets, that sort of area. And of course, the national insurance point that we've covered. They are under huge pressure. I'm going up and down the country at the moment, talking to all sorts of businesses, large and small. I was in Billericay High Street the other day, going in and out of...
Deepest Essex.
Yeah, deepest Essex. It was great. I thoroughly recommend it, actually. It's a fabulous high street. But, talking to, the local pub landlord, going into the hairdressers, a little tea shop and so on, and they are all universally saying the same thing. Comes down to tax and regulation. And the problem is, and you're right to highlight that my background is setting up small businesses and so on. Here and in America, and we've got plenty of that experience on our front bench. Labour don't have any of that experience. And if you look across, rather depressingly across the dispatch box, at their politicians on the front bench, they're all sort of public sector or trade union backgrounds. They're not used to understanding what it is to set up and run a business. And it really is tough. And businesses need government often to get out of the way or to make life easier for them, not to load them up with all these extra costs.
Let's just focus, Mel, if I may, on your party, the Conservative Party, how yourself, your leader, Kemi Badenoch, Andrew Griffith, who we've mentioned, the senior team, how you're positioning yourselves these days. It does strike me that certainly you've bottomed out in the polls. You've been at sort of 17, 18% vote share with respect over recent months. I think that's now edging up slightly, sort of 18, 19, 20% I saw in one poll, obviously much lower than the Tory party would be historically, but you are coming off the back of a really bad election defeat. But it strikes me as a sort of interested outsider, if you like, somebody who observes our politics closely, and particularly the centre right of politics. It does strike me that the Tory party has changed its tune. That's not an accusation. You know, when the facts change, you change your mind, right? It's the name of this Substack. But it does strike me now you're toughening up your message. It is unusual for a party in opposition to really stress fiscal prudence, saving money, controlling public spending, even cutting public spending in some areas when you are in opposition. How did that change come about, Mel? And why are the Tory party making that change? And how do you think it's going?
So I think that we are in a really difficult position economically. We've seen that with the latest budget and the lost headroom and so on and so forth. And under those circumstances in particular, where you've got very high levels of debt, very high levels of debt servicing costs, because of course interest rates are higher than they were some years ago when they were near zero. We're paying about 100 billion a year just servicing that debt, which is twice what we spend on defence. In that kind of environment, things like living within your means, fiscal responsibility become particularly important. And my party, I'm not saying we've always got it right in the past, but by and large, we have been that party that understands the importance of living within your means. So when we had our conference a few months back, one of the things that I did was to explain how we would find £47 billion worth of savings across government, 23 billion of that from the welfare budget. So we can't afford to keep people on benefits. We need to get them into work. And by doing that, both being able to bear down on the deficit and therefore try and get that debt under control, but equally to be able to cut taxes, particularly in areas that are going to grow the economy, because there's no doubt that going forward, growth is the main thing. Now, to your question about why is this message important and why are we really pushing that message out there, I think it should get cut through because you've seen what Labour are doing with the economy, messing it up, taking the wrong decisions and so on. For Nigel Farage and Reform are fantasy economists. They talk about cutting everybody's taxes left, right and centre, and no real explanation as to how they're going to pay for that. And we've seen that playbook in the past and we know how it ends up. So I think we've got to be that responsible, grown-up party that's got a clear plan for living within our means, but also a clear plan, particularly on tax, as to how we're going to grow the economy rather than hold it back.
It has been a process, though, Mel, hasn't it? Being honest, it has been a process within your party. There is a nervousness about saying to the electorate, oh, we think we should spend less. There'll be some on the left of your party, with huge respect, who will be squeamish about that message, just like there were some and are some on the left of your party who are squeamish about your leader saying that net zero is impossible by 2050.
Well, I think there is quite an appetite for the principal measures that we put forward in terms of controlling spending. So if you take welfare, that's 23 billion. I think most people feel that the whole system is out of balance. And we've got these spiralling welfare benefits, particularly around sickness and disability and health and so on. And that in so many cases there, people can be encouraged and supported back into work and indeed are better off when they're in work, particularly if you're looking at less severe mental health conditions. And another big area of savings that we set out was the size of the civil service. Now, the civil service has grown between 2016 and the present day by 37%. And what we are saying, it's just completely bonkers. So we are saying we will get it back to that level. And anybody who grumbles about that, well, my comment would be, the British state didn't fall apart in 2016 because it had too few civil servants. So those kind of things are eminently achievable. And if you're prepared to do that and have the clear plan to deliver on that, then that's when you can start to take big tax choices. And we set out, for example, abolishing stamp duty on primary primary residences, get that gummed up property market moving, which has a big economic consequence. People can then move more readily to where the work is. People can downsize when the kids leave and free up supply in the housing market. Really important tax to get rid of. Secondly, 250,000 small businesses, pubs, restaurants in high streets, getting them out of business rates altogether. Be a huge shot in the arm. And finally, we came out with a big, bold offer to young people, such that some of their tax on their first job actually goes into providing a deposit for that first home. So you can start to do those things if you take the big choices on spending.
Finally, Mel, I'm from a financial markets background, as you know. I know you are very much somebody with a former business background who keeps a close eye on financial markets anyway, aside from the fact that you're the shadow chancellor. A lot of people I talk to in the markets, in the city of London, just down the road, there is a growing sense that the UK economy, particularly the public finances, particularly the market for government debt, the so-called gilts market, is febrile, it's fragile. We had the Bank of England's financial stability report that just came out, the governor pointing to an increasing flows of what so-called hot money, hedge fund money, going into government gilts, maybe shorting them, maybe getting ready to make money from some kind of systemic moment, some kind of fiscal meltdown. You're not in the business of talking down the UK economy, and nor am I, but we're both in positions where we have public platforms, and you are a potential lawmaker. How worried are you about that scenario, Mel Stride?
I am worried. I'm worried about the level of risk that there is around the markets. And, at the end of the day, our debt gets funded through the so-called kindness of strangers, and they have to have confidence of buying our government debt. And I'm worried because whilst the Chancellor has doubled the so-called fiscal headroom in her last budget, there are still substantial risks against that. I mean, one of them would be, for example, a possible future productivity downgrade. We already saw one of those in the last budget from, I think, an average of 1.3% growth to 1%. Well, the trend over the last 15 years has only been 0.5%. So if the OBR thought, in 2 years' time, do you know what, we're going to go back to the trend growth we've seen, that would take about 28 billion out of that headroom. You've got similar risks around where the path of interest rates go. And of course, you've got this budget that what it's done actually is to jack up taxes in the latter part of this parliament.
Yes.
So 26 billion. Now, that's fine, but they'll be heading into a general election at that point.
Are they really going to do it?
Are they going to do it? And what do the markets think of that? And you've got pressures on the spending side, the special educational needs budget that's been incorporated within the central government sort of finances from 2028. There's a 6 billion pressure there. They're saying they'll find efficiencies in the final year of the scorecard of 4 billion, but they're not explaining where that's going to come from. So there are bits of the architecture here in the budget and the finances which do look pretty, I think you used the word febrile. I think that's exactly the word to use. Let's hope we're all wrong, because the worst thing that we want is some kind of bond crisis or something of that nature, which would be deeply damaging. But there are risks at the moment, and a lot of them are due to this government's decisions.
Hope for the best, prepare for the worst. Mel Stride, Shadow Chancellor, I know you're on your way to your constituency down in Devon to do what MPs do, talk to the men and women who voted for you. Appreciate your time. Thanks a lot for appearing on When the Facts Change.
Great pleasure, Liam. Good to see you.
So that was Mel Stride, Shadow Chancellor, and Kate Nicholls, CEO of UK Hospitality, is still with me. So, Kate, we heard from Mel Stride there. It's obviously a mess. It is, in my view, the most chaotic run-up to budget statement itself and aftermath that I've ever come across. And I've covered budgets, for decades, financial crises, multiple financial crises. It's like a sort of self-inflicted wound. It's not like the oil price is over $100, which is terrible for us as an energy importer. It's not like Britain's in recession. It's not like there's a sort of global financial crisis. And yet Britain seems determined under this government to generate its very own crisis.
Well, it's the most turbulent period that I can remember, and that's saying something. I think what you've got there is actually ministers should just do nothing. I mean, that would have been better.
Get out of the way!
Well, there is get out of the way. But
I'm from the government, and I'm here to help. The most dangerous words in the English language, according to Ronald Reagan.
Terrifying. Yeah, but equally, more importantly, you and I will remember when there was budget purdah for a very good reason, because it impacts markets and it impacts consumers. Right. And actually, that's what we need. We needed more discipline. We needed a period of quiet. If there are difficult things that the government is tackling, do it behind closed doors, do it in private. Talk to people who are affected, who can give you insight. I don't think they're bringing enough insight in, but don't do it in public, because it hits those consumers, and most people don't follow it closely, but all they hear is doom and gloom.
That's right.
The second thing is stop talking the economy down. Try and talk about it
Hallelujah
positively.
To that.
And the third thing is you can't tax your way to growth. You never have been able to, you never will be able to tax your way to growth. So those are three things that government needs to do and stop doing. The biggest thing that I hear when I talk to corporates, private equity, foreign investors, small businesses on the ground, they can't trust anything the government says. And I think that's what we just saw and heard in the other segments of the programme. If the first thing a Labour government does when they come in is take away welfare payments, winter fuel, and do the most regressive tax change that I've ever seen in 30 years by cutting the NIC threshold, they become unpredictable. Not just to our businesses that are directly affected, but to any business, because how can you trust them? And then when they say we're not coming back again for a second bite of taxes, we won't come back and hit the high street, and they do it again, nobody can trust what they're saying. And that's the thing they need to work on the hardest. How do you rebuild trust with a population, voters, but also businesses?
I must say, I think the way they conducted themselves in the run-up to the budget was a disgrace. They're using the 10-year and 30-year gilt yield almost like a sort of clever opinion poll. Do these guys really understand what they're messing with here? Have any of them read any history? What happened in this country in 1976 when we went cap in hand to the International Monetary Fund? Of course, you're far too young to remember that, but I just about remember it. So you're giving me a picture, Kate, and you're very experienced politically. You've worked in the House of Commons, the European Parliament. You've worked for FTSE 100 companies. You know of what you talk, and you're telling me that the view from business of politics at the moment is pretty downbeat.
Absolutely. I think there was an optimism that we would get back to politics as normal, politics as boring, and that's what business was.
When they came in July 2024. When they came in
July, we had
endless CEOs lining up to be interviewed with Keir Starmer and all the rest of it.
But we had a series of shocks. We had a series of chaos.
Madness under the Tories.
Business needs certainty, stability, calm, and they want to get back to business as normal and politics as dull. You and I love politics as interesting. Business wants politics as boring so that they can plan. And they want somebody who's going to take a long-term plan on these big issues like energy, like planning, like infrastructure. And it feels as though it's knee-jerk, and it feels as though it's very reactive and responsive. And that gives people jitters. And if you were an international investor, it's the same as all of us as consumers. When we go out to shop, when we go out to eat and drink, we're investing our money in UK PLC. And if you don't feel that you can risk it, you're going to hoard it, you're going to save it, you're going to hold back. International businesses are no different. Small businesses are no different. They're not going to invest. So we need to get back. That's the thing. Businesses don't feel confident in the government, can't trust what is being said, can't believe it, and we need to work together to get through that.
Kate Nicholls, consumer guru, chair, of course, of UK Hospitality. Thanks so much for appearing here on When the Facts Change. So that's it from this, the second edition of my When the Facts Change show. Thanks so much again for your support. It's going to be a regular gig, released on a Friday morning, so please spread the word. I'll be broadening out the reach of the show so it covers not just the UK and the US, but other parts of the global economy in future weeks. And until then, thanks for joining me on When the Facts Change. Thanks for joining When the Facts Change, economics and politics in a fast-moving world with me, Liam Halligan. please subscribe to my When the Facts Change YouTube channel and my podcast via Spotify, the podcast app, or wherever you listen. And above all, please subscribe to my When the Facts Change Substack for more of my interviews and writing.